The models that have dominated quantitative finance for decades are breaking. In an era defined by unprecedented geopolitical friction, sudden supply chain fractures, and viral information, the very foundation of traditional quant, the reliance on historical data, is proving to be a fatal flaw. These backward-looking models, meticulously calibrated on the market patterns of yesterday, are fundamentally ill-equipped to navigate the turbulence of today and the shocks of tomorrow. They operate on the assumption that the future will, in some measurable way, resemble the past. Yet this assumption is being shattered before our eyes. Historical data, however vast, contains no blueprint for a global pandemic, no precedent for a trade war waged over microchips, and no algorithm for the sudden eruption of a regional conflict that snarls global shipping lanes. Relying on these old maps is like trying to navigate a minefield with a chart of a peaceful meadow. It won't just lead you astray, it will get you blown up. The next black swan event, by its very definition, will not be in your dataset. It will not announce itself through conventional market signals. The fundamental shift, therefore, is not about refining old methods, but about forging new ones. It's a transition from reacting to the past to actively anticipating the unseen. A paradigm shift from quantitative analysis to predictive intelligence. The revolution begins by looking beyond the sterile confines of financial statements and price charts. It requires decoding the hidden signals embedded in the fabric of our hyper-connected world, signals that traditional finance has long ignored. This is where artificial intelligence enters the theater of operations. The true power of this new paradigm lies in the AI's ability to serve as a market navigator, mapping the bewilderingly complex web of cause and effect that governs our global economy. Human cognition, brilliant as it is, struggles to process more than a handful of variables simultaneously. Machine learning, however, thrives on this complexity. It can ingest thousands of disparate data streams, from satellite imagery and social sentiment to shipping data and patent filings, and begin to map the nonlinear, often counterintuitive relationships between them. It learns how a drought in Brazil might ultimately affect the stock price of a European automaker, or how a single political speech in Asia can ripple through global semiconductor supply chains. This allows the AI to move beyond mere correlation and toward a sophisticated form of predictive modeling. It can identify and forecast economic catalysts long before they become screaming headlines on financial news networks. While a team of human analysts might take weeks to piece together the puzzle of a potential shift in central bank policy, an AI can process the subtle changes in the language of policymakers, cross-reference it with macroeconomic indicators and market positioning data, and flag the high probability of a policy pivot in a matter of minutes. This is the ultimate algorithmic advantage: speed and scale. The AI doesn't sleep, it doesn't get distracted, and it can process the entirety of global information flow in near real time. In a market where a microsecond can mean the difference between profit and loss, this ability to see around the corner, to anticipate the next move on the global chessboard, is an unparalleled strategic asset. The emergence of this powerful predictive capability demands a fundamental rethink of portfolio construction and risk management. Tomorrow's portfolio cannot be built solely on past performance in traditional asset allocation models. It must become a dynamic entity capable of adapting to the insights generated by AI. The first step is integrating these AI-driven predictions into the core of investment decision-making. This doesn't mean blindly following an algorithm. It means using the AI's output as a new, powerful input. If an AI model predicts a high probability of disruption in a specific agricultural commodity due to changing weather patterns identified via satellite data, a portfolio manager can proactively adjust their exposure hedge against the risk or identify second-order beneficiaries of the disruption. This leads to a new frontier in risk management. Instead of merely insuring against past volatility, investors can begin to calibrate their defenses for unseen shifts predicted by the AI. It's the difference between reinforcing a seawall based on the last tsunami and building a new defense system based on a seismic forecast of the next one. This new environment also transforms the role of the human investor. The future is not one of humans being replaced by machines, but of humans being augmented by them. The AI provides the what, the probabilistic forecast, the identified risk, the hidden opportunity. The human provides the why and the what now, the strategic context, the ethical oversight, the nuanced judgment, and the final decision-making authority. The human investor evolves from a data analyst into a strategic commander, interpreting the intelligence provided by their AI counterpart and directing the deployment of capital accordingly. To thrive in this new quant era, you must actively seek your edge. This is not a future you can afford to passively observe. It is a frontier you must actively explore. The actionable first step is to educate yourself on the capabilities and limitations of AI in finance. Begin by seeking out asset managers and financial platforms that are transparent about their use of non-traditional data and machine learning in their investment process. Ask the hard questions. What are your data sources? How are your models validated? How do you integrate AI insights with human oversight? Furthermore, a number of powerful tools and resources are becoming accessible, allowing individual investors to explore this frontier. Platforms offering sentiment analysis on stocks, services providing satellite-based economic indicators, and newsletters dedicated to the intersection of AI and geopolitics can provide a valuable layer of insight to complement traditional research. Start small, perhaps by using these tools to analyze a single sector or to stress test one of your existing investment theses. The objective is to build your own intuition for how these new forms of data translate into market movements. Ultimately, you must internalize the central lesson of this paradigm shift. The future of investing will not be won by those who have the most data, but by those who possess the deepest understanding of what that data truly means. It's about learning to see the signals in the noise, to read the map of a world that is constantly being redrawn. The future is not just about analyzing the scene. It's about having the vision and the tools to understand the unseen.